In an unprecedented move, the Federal Reserve just cut interest rates by 50 basis points. What does this mean for our economy?
Today we'll be hearing insights from economist Steve Hanke, who reveals the implications of this significant cut and how it might shape inflation trends moving forward.
Stay tuned as Hanke unpacks key points regarding the money supply and labor market health. There are some eye-opening revelations ahead. Welcome to Financial Insights in Minutes, your go-to channel for quick yet comprehensive financial summaries.
Our AI-generated summaries help you grasp crucial financial insights rapidly, leveraging decades of experience in economic analysis. So, what should be on our radar next? Hanke emphasizes the risks of rising unemployment and the importance of closely monitoring economic fluctuations.
Absolutely. Understanding these risks may be the key to safeguarding your investments in the coming months. Let's dig deeper. Let's dive right in. Today, we're unpacking the recent decision of the Federal Reserve to cut interest rates by 50 basis points.
Joining us is Steve Hanke, a recognized authority on inflation and monetary policy, here to help us navigate these turbulent economic waters.
What's the key takeaway from Hanke's insights about this rate cut?
The main thesis is that the impact of the rate cut may be minimal, as the money supply is contracting, indicating inflation will continue to decline contrary to popular belief.
Let's break down the key points. What about the actions of the Federal Reserve?
The Fed's decision marks their first rate cut in over 4 years, dramatically shifting expectations. This cut directly challenges the assumption that a smaller cut would suffice.
And what does Hanke say about the money supply?
He highlights that the money supply is growing at just 1.26%, significantly below the ideal 6%, which has historically led to recessions whenever contraction occurred.
What's the future of inflation, according to our guest?
Hanke firmly believes inflation will continue to decline, potentially dropping below the 2% target due to the ongoing monetary contraction. Concerns about stagflation are unfounded, he argues.
And what about the labor market? What crucial insight does Hanke provide?
Hanke points out that while the Fed claims the labor market is strong, the projected rise in unemployment reveals underlying weaknesses. Confusion reigns with conflicting messages from Fed officials.
What does Hanke predict regarding the looming recession?
He foresees a recession as inevitable, warning that historical patterns suggest contracting money supply typically precedes economic downturns. This warrants serious concern.
And what about the expected interest rates in the near future?
The Fed may lower rates further, potentially dipping toward 3.4% by 2025. However, Hanke warns these cuts won't necessarily trigger inflation. His focus remains on money supply metrics.
As we wrap up, what's the crucial takeaway from Hanke's analysis?
Hanke emphasizes proactive money supply management to stave off inflation and effectively navigate economic turbulence. He calls for vigilance and long-term strategies.
What final advice does Hanke offer regarding economic indicators?
He stresses that staying informed on money supply and inflation trends is vital for accurate predictions. Ignoring these could lead to serious miscalculations.
So what's the bottom line for our viewers?
Stay engaged with economic developments and seek credible sources for guidance. The only thing we can predict is uncertainty.
Time to navigate through these waters. Today's focus, the Federal Reserve's drastic pivot with a surprising 50 basis point rate cut.
Here's the full scoop. This shift from a higher for longer stance to a rapid cut suggests deeper economic concern.
What's the essence of this Fed decision? What does it really mean for the economy?
The core message is clear. The Fed acknowledges a precarious economic landscape, realizing that interest rates need to lower significantly to stabilize the situation.
Let's break it down. How significant was this rate cut?
This cut indicates a dramatic turnaround from the Fed's previous position. They shifted from considering lengthy rate hikes to slashing rates almost overnight.
What about the market's response to this news?
Interestingly, there wasn't a huge reaction. The markets had already priced in the reality of lowering rates long before the Fed officially cut them.
And what do the projections say now?
The markets are projecting even larger cuts ahead, with 6-month yields already dropping significantly. It's like a crystal ball predicting lower rates.
Now let's talk about hiring. What's the latest?
The slowdown in hiring is significant. It's a key trigger for economic downturns, indicating rising unemployment that compounds the Fed's concerns.
What does the future hold for rates, according to experts?
Experts foresee additional cuts. However, the markets are skeptical about their effectiveness, suggesting that rates might not rise even after the cuts.
What economic repercussions might we see?
Deeper recession signals are surfacing, with heightened market volatility expected as the Fed navigates through turbulent waters.
So what should we take away from this discussion?
The Fed's quick action indicates mounting concerns about the economy. Keeping an eye on further developments is crucial. This story isn't over yet.
In closing, what's your game plan moving forward?
Staying informed is key. Future shifts could affect everything from interest rates to market stability.
Let's dive right in. What happened following that big cut from the Fed?
A lot, actually. The market's been buzzing with activity after that significant two-day response to the Fed's rate cut.
So, what's the main thesis of today's discussion?
The core thesis is clear. The Fed's rate cut creates a ripple effect in the market, significantly influencing investor behavior.
What about those initial jobless claims?
The initial claims at 219,000 were well below the anticipated number, signaling a resilient labor market, which surprised many.
And what does the market reaction look like?
The markets reacted positively, with major indices soaring, but concerns about possible market correction linger.
What should traders focus on in the upcoming days?
All eyes are on the upcoming employment report, which could consolidate current gains or stir market volatility.
Got any predictions on where the market might head next?
It looks like sustained bullishness, but keep an eye on international events that might shake things up.
So, there's a chance of a correction coming up.
Absolutely. Excessive bullish sentiment can tempt corrections, especially amidst global uncertainties.
As we wrap up, what should investors take away from today's insights?
Caution. Investing involves balancing optimism with minimizing risks, especially amidst turbulent times.
And remember to stay informed about market trends.
Subscribe to ensure you don't miss out on future content that could help your trading game.
Our next insightful summary dives into a troubling trend. Why are corporate executives selling their stocks at an alarming rate? Jesse Felder, founder of the Felder Report, uncovers some eye-opening data.
Indeed, Felder argues that we may be on the brink of an earnings recession as executives foresee a slowdown in the economy over the next year or two. Let's unpack what this could mean for investors.
Let's get to the core of Felder's predictions. What's causing so much concern among corporate executives?
Felder emphasizes that the alarming rate of insider selling suggests a peak in earnings growth and an upcoming recession. According to his analysis, the market seems too complacent about when these economic shifts will happen.
Now let's break down the key points. What are these insiders signaling?
Felder notes a significant rise in the insider sell-to-buy ratio, indicating more executives are selling stocks than buying. This historically points to weakening market conditions.
What's the state of the job market today?
Felder points out a troubling decline in hiring. Major job cuts reported signify potential economic trouble that could ripple through consumer spending patterns.
So, what does this mean for the future?
It raises the question, can we realistically expect a soft landing? Felder argues contrary indicators suggest a much more difficult economic environment is ahead.
What's the call for earnings moving forward?
Felder predicts we're facing an earnings recession within the next 12 to 18 months, driven primarily by executive sentiment and visible economic cracks.
And what about market stability?
Felder suggests a rise in market volatility as investors react to the increasingly bearish outlook. Sharp corrections could be on the horizon.
What are the final takeaways from Felder's analysis?
Potential investor caution is paramount. Current trends highlight a pressing need for tactical adjustments, whether in asset allocations or financial strategies.
Any last thoughts to wrap this all up?
Ambivalence in the market shouldn't distract investors from observing executive actions. Increased vigilance now could translate to better decision-making down the line.
Before we dive into the next summary, what do you think influences market conditions most right now?
Let's hear your thoughts. Drop a comment and keep the conversation going.
Let's dive right in. Today we're examining the substantial 50 basis point cut by the Federal Reserve. Was this a panic move, And what does it mean for the turbulence in the markets?
Absolutely. The insights shared by Tom give us a deep view into market structure, dark pool transactions, and the resistance levels that could define what's next for stocks, cryptos, and commodities. Buckle up.
So, what's the crux of the video? What's driving the market's jitters?
The core thesis presented by Tom indicates that this bold 50 basis point cut is typically reserved for recessionary times. Market reactions suggest traders are processing significant uncertainties about future economic conditions.
Let's break down the key points. What do we need to watch for in terms of market behavior?
Tom emphasizes the market's tendency to overreact immediately after news breaks, suggesting we might not see true movement until 3 days post-announcement. Timing is everything.
And how does the Fed's statement factor into all of this?
Tom points out that the 50 basis point cut reflects the Fed's intent to support job stability amidst declining economic forecasts. They are clearly trying to ensure they're not falling behind policy-wise.
Wow, those predictions sound serious. What should we anticipate?
Yes, forecasts indicate potential job losses if the economy doesn't stabilize. Tom believes market responses in the next month will shape further projections.
So what are the predictions looking like if this trend continues?
Tom foresees that if economic indicators worsen, we could indeed be facing a significant recession. Investors may lean toward conservative strategies and assets during this potential downturn.
And what about market volatility?
Tom mentions that we should brace for heightened volatility as the market reacts to both Fed decisions and broader economic signals. Safe investments might become the focal point for nervous investors.
To wrap up, what's our key takeaway from all this?
Tom's insights suggest we must prepare for potential recessionary conditions while also being aware of ongoing volatility. The question remains, how will you adapt your investment strategies in response?
What should viewers focus on moving forward?
Monitoring economic indicators will be vital. Preparing for shifts in market sentiment could be the key to weathering potential downturns.
Before we call it a day, let's hear your thoughts. How will you react to these evolving market conditions?
Share your investment strategies in the comments. It's essential to engage with our community as we navigate this potential economic storm together.
That's a wrap on today's discussion about the implications of the Fed's dramatic interest rate cut.
Indeed, Steve Hanke certainly provided some thought-provoking insights on how this could impact inflation and unemployment.
And he stressed the importance of monitoring economic fluctuations closely to protect our investments.
Absolutely. It's critical to navigate these uncertain waters with informed strategies.
For our viewers, if you found this information valuable, please like and subscribe to our channel for more timely updates.
Don't miss out. Join us for our next episodes that promise more insights on the evolving economic landscape.
Thank you for tuning in to Financial Insights in Minutes. Stay informed and see you next time.